our discussions for the conceptual framework. Today we will be discussing the measurement component of the framework. Now just remember that the measurement component has not yet been completed in terms of the improvement project, so here we're still dealing with the 1989 framework. So what are we talking about when we talk about measurement? The framework refers to this as the process of determining monetary amounts at which the elements, namely assets, liabilities, equity, etc., of financial statements are to be recognized and carried. Now this involves the selection of a measurement basis, not quite as simple as cost or fair value. I'll elaborate shortly. Now just take note, the framework currently does not prescribe a measurement basis. What it does do, however, is it just tells you some of the measurement basis that are included in the accounting standards. Now, this part of the framework is a little bit outdated, and it tells us the first type of measurement basis noted is the historical cost, which is the most common. Then it also notes current cost, which is pointing towards fair values, realizable or settlement value, again pointing towards fair value, and present value. There we're dealing with discounting cash flows. Just quickly to run through what each of those four measurement bases noted are. So, historical cost. Here, assets are recorded at the amount of the cash paid or fair value of consideration given. This is very, very important, please. So, fair value of consideration given. Here are some standards that will always address this are property, plant and equipment, IAS 16. Initially, PPE recognized at cost. Okay, this is what they're talking about. Subsequent measurement, yes, could be revaluation. Initial recognition is what I'm referring to here. So PPE, intangible assets, investment property, so that's IAS 38 and IAS 40, all initially recognized at cost. One that we also always forget about is subsidiaries. Subsidiaries, initial recognition at the fair value of consideration given. Okay, so on the liability side now, liabilities are recorded at the amount of proceeds received in exchange for taking on an obligation, or at the amount of cash expected to be paid to satisfy the liability in the normal course of business. Please remember there will be some type of present value if there's a time value of money component. Current cost, again, start thinking towards fair value. At the time this framework was drawn up, the 1989 framework, there was no IFRS 13, the standard on fair values. So assets, current cost would be the amount of cash paid to acquire the same or an equivalent asset. Liabilities, undiscounted amount of cash that would be required to settle the obligation currently. Now this goes back in history of accounting. We used to apply back in the 60s something called inflation accounting. After that, they looked to something called current cost accounting and then concurrent cost accounting, which all looked at current prices of what you would get if you sold that asset or what you would have to pay if you settled that liability today. Realizable or settlement value. Now, this is very important for certain standards. IAS 2 inventory carried at lower of cost or net realizable value. Also, IFRS 5 assets that are held for sale. There you would look at your fair value minus cost to sell, which is very closely related to a settlement value, or IAS 36 for your recoverable amount higher of value in use, different concept, or fair value minus cost to sell, very similar to settlement value. So assets would be the amount of cash that could currently be obtained by selling the asset in an orderly transaction. For liabilities, well, there's settlement values, which are the undiscounted amount of cash expected to be paid to satisfy the liabilities in the normal course of business. Also, again, pointing us towards fair values. Old wording, this framework. I'm hoping the new, improved framework will do quite a bit with this measurement basis. The last one that they note specifically is present values. Here, for assets and liabilities, you're looking at cash flows on a timeline and a present value, a point in time today. Well, all those future cash flows need to be present valued at a discount rate to give me the present value, or what we often call the net present value of those future cash flows. So for assets, the present discounted value of the future net cash inflows that the item is expected to generate. Liabilities, the present discounted value of the future cash outflows that are expected to be required to settle the liabilities. So please remember, this measurement basis is the old framework still. It has not yet been updated in terms of the new improved conceptual framework for general financial reporting. So it does not prescribe a measurement basis. So it's not prescriptive. And just from an interest perspective, this is probably the most political argument within the standard setting bodies. What we are hoping for is that at some point the framework will start becoming prescriptive. It'll say the theory of accounting is we should measure at historical cost or fair values, etc. They have taken steps in other standards to now define what fair value is more, so that's IFRS 13. And again, the argument, historical cost camp versus fair value camp, is this ever going to be settled? Who knows, because both have very good valid arguments. Great. See you in the next lecture. Thank you.